All right, let's just jump right into this explainer. Today, I'm putting on my hat as a seasoned, deeply skeptical equity research analyst. We are going to strip away all those flashy AI headlines, those surface-level revenue beats, and all the market noise. Why? To conduct a true forensic audit of Innio NV, trading under the ticker INIO. We're getting our hands dirty in the SEC filings, the 10K, the 10Q, acting as actual investigative journalists of their financial statements. So expect absolutely zero hype here, just pure, data-driven, objective financial analysis.
But hey, first things first, the lawyers need to speak, so please read this along with me. Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
Okay, here's our data-driven structure for today. First, we'll look at the AI power play. Second, financials, growth versus debt. Third, we run the valuation gauntlet. Fourth, we'll dig into the red and green flags. Fifth, we do a legendary investor check. And finally, number 6, the final verdict and moat synthesis.
Starting off with Section 1, the AI power play, focusing on microgrids and data centers.
Look, it's no secret that artificial intelligence requires a just staggering amount of computing power. And that, of course, demands a massive, unprecedented amount of electricity. Right now, in the US and Europe, grid interconnection delays are literally exceeding 6 years in some areas. AI data centers simply can't afford to sit around and wait for that. So what are they doing? They're aggressively pivoting to behind-the-meter microgrids, basically generating their own power right on site. And honestly, this is exactly where INIO steps in. In the energy sector, we use this metric called LCOE, levelized cost of energy. Think of it as the average total cost to build and operate a power plant over its entire lifetime divided by its total energy output. Well, INIO's gas engines deliver an LCOE of just $103 per megawatt hour. To put that in perspective, that is vastly cheaper than relying on the grid. It's cheaper than the $106 you'd pay for simple cycle turbines and way, way cheaper than the $140 for fuel cells. Oh, and as a bonus, their platforms are 100% hydrogen ready. So they bypass current grid constraints entirely while totally future-proofing for green energy.
And if you want to see what that demand actually looks like, just look at this number, 2.8. That is Innio's book-to-bill ratio. What does that mean? It means they're getting $2.80 in new orders for every single dollar they actually bill and ship out. That kind of demand has generated a massive $4.8 billion equipment backlog. When you realize that 59% of those orders are coming straight from data centers, it becomes pretty clear we're looking at a structural boom in this highly specific niche.
Moving on to Section 2, financials. We're pitting growth against debt in what's known as the razor and blade model.
So, let's take a hard look at the income statement and balance sheet because we really need to contrast this massive top-line growth with the actual highly leveraged realities of the business. Check out this juxtaposition. In Q2, total revenue was a stellar $937.7 million. I mean, that's an incredible 42% year-over-year increase. But hold on, look at the second bar. That top-line explosion somehow contracted into a net loss of negative $16.9 million. So you're probably asking, how on earth does that happen? Well, it's driven by two massive anchors dragging them down. First, a one-time $81.2 million hit for IPO and public market readiness, and second, a really crushing interest expense load that completely doubled to $123.7 million in just the first half of the year. To figure out how they plan to dig themselves out of that hole, we have to examine their razor and blade business model. See, equipment sales, the literal engines, accounted for 52% of their revenue, but only brought in 35% of their adjusted segment EBITDA. The real money here is in the blades. Services make up 48% of revenue, but they generate a massive 65% of the actual profit. The strategy is pretty classic. They sell the engine at a lower margin to aggressively grab market share, and then they lock that customer into these high-friction, highly profitable long-term service agreements.
All right, buckle up for Section 3, the valuation gauntlet, looking closely at market multiples and debt ratios.
Right now, this stock trades at some seriously elevated multiples. We're talking an EV to EBITDA of 44.93 and a staggering price-to-book ratio of 89.97, all while lugging around an immense total debt load of $2.618 billion. Now, take a deep breath with me, because we are going to force all this data through 21 different valuation models to find the calculated intrinsic value per share. Let's start with Group A, cash flow. A standard WACC DCF yields $18.50 per share because of elevated capital costs. Unlevered free cash flow bumps that to $22, mainly because it ignores the debt structure. But then free cash flow to the firm drops it to $15.20 when compared to enterprise value. And free cash flow to equity absolutely plummets to $10.50 thanks to massive debt servicing. Finally, the adjusted present value sits around $20 if we factor in the tax shields from all that interest. Okay, moving to Group B, dividend and income models. The DDM, GGM, and multi-stage DDM all mathematically spit out $0. Why? They pay zero dividends to common shares. The residual income model gives us a rather dismal $2.10 based on their low book value, and EVA shows a negative spread against their capital charge, giving us $12. Let's look at Group C, comparables. Sector peers suggest a price of $30, while historical acquisitions point to $35. Trailing and forward PE, honestly, completely NA because of those net losses we talked about. A price to book using sector averages yields just $150, EV to EBITDA prices it at $14.80, and EV to sales is a bit generous at $32. What about Group D, the balance sheet? Book value per share is quite literally $0.29 given all their leverage. Net asset value is $0.25. Liquidation value, like a true fire sale, is a cool 10 cents. Though to be fair, the replacement cost to rebuild their entire footprint today would be about $15. And lastly, Group E. Real options valuation yields $28, which basically prices in the upside of their ongoing 10-gigawatt capacity expansion. Phew, we survived the gauntlet.
Let's pivot to Section 4, red flags and green flags. This is where we get into the details of the media blackout.
So as you just saw, the models are all over the place and they are heavily skewed downward by that debt. For this part, we are completely ignoring those flashy headline revenue beats. We want to find out what's buried deep in the footnotes. Here are 7 deep red flags. First, a massive $723.8 million private equity dividend recapitalization. The media totally ignores this because sponsor exit liquidity doesn't really fit that rosy AI growth narrative, does it? Second, an H1 net loss of $25.9 million. I mean, why report that when you can focus entirely on top-line revenue beats? Third, a whopping $3.3 billion in undiscounted future cash outflows on debt. I guess that's simply too complex for a quick 30-second soundbite on financial TV. Fourth, their adjusted EBITDA margin actually contracted to 18%, but that gets completely overshadowed by raw dollar EBITDA growth. Fifth, $91.1 million in IPO readiness costs, which are often conveniently written off as just a one-time event. Sixth, their interest expense doubled to $123.7 million. It's hard for analysts to talk about that when it completely ruins the operational success story. And seventh, cash conversion decelerated to 57.9%. Let's be real, cash flow timing mechanics are just far too walky to make for good retail headlines.
But hey, we have to stay objective here, and honestly, some of these footnotes are genuinely impressive. So here are 7 totally overlooked green flags. First, that massive $4.8 billion equipment backlog. The media ignores this because remaining performance obligation schedules are buried super deep in the 10Q. Second, an incredible $309.7 million cash inflow just from customer prepayments. Unearned revenue accounting might be too dense for the daily news, but let me tell you, it's a huge operational advantage. Third, their local-for-local manufacturing helps them beat those 200% tariffs. Supply chain geographic moats aren't as flashy as talking about AI chips, but they absolutely matter. Fourth, we have that $103 per megawatt-hour LCOE cost advantage. Levelized cost models require way too much industry-specific knowledge to make the evening news. Fifth, that 2.8x book-to-bill ratio. This usually gets overshadowed by standard quarter-over-quarter growth metrics. Sixth, they're 100% hydrogen-ready platforms. This is often viewed as too far in the future for short-term trading updates. And seventh, 79% of their total $8.8 billion obligations will be recognized within just 24 months. Sure, revenue recognition timelines are notoriously dry, but make no mistake, that is a massive wall of guaranteed future cash.
Now, the crucial point here is comparing the most glaring red flag right alongside the most powerful green flag. On the left, we've got private equity sponsors extracting massive amounts of cash via new debt right before the IPO. That is a classic bearish exit liquidity move. But look on the right. INIO masterfully offsets their heavy physical inventory needs by securing massive upfront cash payments from their customers. Over $309 million in unearned revenue basically means customers are entirely funding their manufacturing cycle for them. And honestly, that is a phenomenal structural financing advantage.
Section 5. The legendary investor check. Let's see what Graham, Lynch, and Buffett would think.
So I have to ask you, based on everything we've uncovered so far, would Ben Graham, Peter Lynch, or Warren Buffett actually buy Innio today? Let's run their exact philosophies and find out.
Starting with Ben Graham.
If we calculate the Graham number, which is the square root of 22.5 times earnings per share times book value per share, well, because EPS is negative and book value is just pennies, the number fails entirely. The price utterly fails to meet net current asset value, and the PE is definitely not under 15. Graham would run far, far away from this one. Moving on to Peter Lynch, we calculate his PEG ratio, which is price to earnings relative to growth. If you use adjusted forward metrics, Lynch might actually give this a pass. His fair value check might totally embrace that massive 2.8x book-to-bill ratio and the broader AI growth story. Finally, Warren Buffett. We have to analyze owner's earnings here. That's net income plus depreciation and amortization minus maintenance capex, and those numbers are heavily pressured. Buffett wants a return on invested capital over 15% consistently, but INIO is really struggling against its debt. Plus, he would absolutely hate that 3.59x net debt to EBITDA ratio. So while Buffett would undoubtedly admire the wide economic moat provided by their service contracts, he would ultimately pass due to that highly leveraged balance sheet.
And finally, Section 6, Final Verdict, the moat synthesis, where we put it all together. All right, let's synthesize this. Based on our intense gauntlet of 21 valuation models, INI is currently overvalued. While some optimistic comparable models point to the low 30s, the crushing weight of their debt drags the average intrinsic value down to somewhere in the $12 to $14 range, which is well below its current trading price. The 89.97 price to book and 44.93 EV to EBITDA multiples, they are simply pricing in absolute undeniable perfection.
Now, despite that stretched valuation, INIO possesses an absolutely undeniable economic moat. According to Morningstar's 5 sources, their moat is basically built on 2 main pillars. First, an intangible cost advantage, delivering power at $103 per megawatt hour to completely bypass grid delays. And second, high switching costs, which lock clients into those really high-margin long-term service agreements. Given the rapidly escalating constraints on AI data center power, we strongly project this moat will actively expand over the next 3 years.
So here's the bottom line. The business operations are spectacular. They are masterfully using customer prepayments to fund a massive backlog, but the financial structure is pretty perilous, heavily weighed down by private equity debt extraction and tightening margins. The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Do your own homework.